So again, my name is Sandra Henry. I am the Learning Services Assistant here at Philanthropy, New York. Thank you so much for coming. Just one more reminder to our online listeners to mute yourselves. Everyone should be muted upon entry, but just in case, be sure to look at the instructions that were sent to you yesterday. And if you have any questions, you can email support@philanthropynewyork.org or register@philanthropynewyork.org. So once again, I want to thank you for joining us for using financial statements together with IRS Form 990 to understand your potential grantees, and to thank Candice Meth, who has been leading all of our financial series. She is the Senior Manager for the Not-for-Profit Services Group from EisnerAmper. So thank you again, Candice, for leading us in these wonderfully informative series of programs.
Thank you. Good morning, everyone. So today what we're going to do is we're going to take a look at, I can't advance. Hold on one second. We're just having trouble advancing the slide. Okay. We're going to be taking a look at the information that you can gather by looking at an organization's financial statements as opposed to what you can get from looking at their Form 990. We're going to talk about some red flags and analysis, some ratio calculations, and then we're going to discuss why the attachments to the Form 990 are really important in terms of gathering information about a potential grantee. Okay, so first we're going to be talking about which document to use and when. So information provided by the financials are going to be the assurances in terms of a fairly presented balance sheet. So the first thing you see in an audited financial statement, of course, is the opinion. And that's the only page that actually belongs to the auditors. And that's where they give you assurances that, from their opinion, the information you're about to read is fairly stated in all material respects. So what that basically means is that upon the auditor's testing, when they took a look at different samples and vouched different items, they didn't come across anything that they thought was misstated and would mislead a reader. Okay? The financial statements will give you the financial condition and the financial health, and will allow you to do some ratio analysis to see how the organization is doing in a given year. But very important are the explanations in the notes. Those notes to the financial statements give you a great deal of information, and they add a little bit of color to the numbers that you're seeing, and they may present things that you would otherwise not know about. For example, potential commitments. They may discuss potential lawsuits that are out there. They'll talk about related party relationships that maybe you want to know that the organization has. So it's very important when you're going through the financial statements to read those notes. I just mentioned related parties. In addition, in the notes, you may see things about donor restrictions or concentrations. When we look at the balance sheet of a nonprofit, you'll see three categories of net assets: unrestricted, temporarily restricted, and permanently restricted. And those categories are required to be presented within the financial statements. Very important to look at those categories because it tells you how much access the entity has to those assets in order to utilize them for different purposes. So for example, you're going to want to see a healthy balance in the unrestricted category because that's what allows them to keep the lights on, if you will. Okay. In terms of donations, in times of financial difficulties, you'll notice that the actual cash donations into charities tends to reduce, but a lot of times it's replaced by non-cash goods, gifts in kind. And so what's important to look at is the valuation of those things, because it can be misleading if you look at the revenue in a given year and it's a large number, and then you see that that number is predominantly made up of gifts in kind. You want to make sure that whatever valuation that they utilize is really fair market value. Otherwise, it can make it look like the organization had a great year in terms of their revenue. Okay. Cash flow. Again, in terms of the cash flow, it's always broken into three parts. Those provided by operating activities versus investing activities versus financing activities. You want to see a healthy amount coming out of operations because that is the core of what they do. And we'll take a look at the different parts of the cash flow. Details about investments. Again, as people become more sophisticated in terms of diversifying a portfolio, they tend to go into some investments that may have restrictions on being able to redeem that money. And that may be something that you want to consider in terms of a nonprofit, whether or not they're going to be able to get out of a particular investment if it should go down, and also whether they maybe have unfunded commitments to a particular investment vehicle, in which case is their cash next year going to be used for their programmatic activity, or is it going to be used for investing activity? So we'll look at that particular note as well. Finally, details of endowment. The endowments of nonprofits tend to get a lot of press, but you want to take a look at what is the size of the endowment. Is it providing a healthy stream of income? Is that income available to be used for the various projects, or is that money really tied up? And what is their spending policy in terms of utilizing that income? I always think it's very interesting. Part of the note disclosure that is required is that you have to talk about what your policy is in terms of investing. What is your goal? So a lot of times you'll see that the goal will say, we invest the endowment to create a predictable stream of income, and we target a 4% return. And then right below that, it says that their spending policy is 6 or 7%. So they're basically telling you right away that they're trying to spend more that they know they're going to earn. So those are the things that you want to take a look at, and you won't find that unless you look at the notes to the financial statement. Okay. Things that you can see within the tax return. The IRS, when they put out the redesigned form of the 990, included all those lovely governance questions. Again, I always point out that the IRS actually has no ability to enforce compliance with any of those questions. But the idea was, let's put the question out there. This is a public document. And if you will, we will kind of shame you into adopting good governance, because who wants to tell the world that you don't have these policies, right? And then there are the watchdog agencies out there that are rating charities on their responses to these questions. So it's kind of been a very passive-aggressive way to get charities to really step up their governance policies, which is a good thing no matter what. But looking at the answers to those governance questions will tell you how this organization is running. The IRS actually conducted a study to see whether those charities that answered the governance questions in a certain way had better or worse financial health or had any sort of fraud. And they didn't necessarily find exact one-to-one correlations, but there were certain questions that when the answer to that was a good governance, strong answer, that organization tended to fare better. Okay. In terms of expenses, in a nonprofit's financial statement, there is a lot of flexibility in terms of what they're required to present. And so that's the reason why you can look at the financials of one organization against another, and they may look very, very different. So one of the things that a nonprofit is not required to give you is a functional expense detail unless they are a health and welfare organization. Where you can get that detail of functional expenses is always in the 990, page 10 of the 990. So if you open the financials and you don't necessarily see the breakdown of expenses in terms of salaries, professional fees, and all those line items that you're interested in, you can always find that information in the tax return on page 10. Okay? In terms of categories of expenses for ratio analysis. So one of the things that is required in a nonprofit's financial statements is somewhere, whether it be on the statement of activities or in a note, they are supposed to give you the aggregate amount of programmatic, management in general, and fundraising expenses for the year. They don't have to do it in their statement of activities. They could do it back in a note disclosure, but they are supposed to give you those grand totals, and that allows you to do a ratio analysis. That allows you to say, how much is this organization actually spending on fundraising every year? Compare that to how much revenue they brought in during the year. Is it worth it? Are they throwing away a lot of money in fundraising efforts and they don't seem to be bringing in a lot of contributions? Is there a concern that the money that you might give to this potential grantee won't be used on programmatic purposes if their percentage of program is very low? So these are the types of things that you may or may not be able to get from the financial statement and the detail that you want. But again, in the tax return, that detail is, again, right there for you on page 10. not only is it the functional expenses, but they're in the columns, programmatic, management in general, and fundraising. And there's a lot of detail paid to those columns by watchdog agencies. That's part of the whole rating system, is what they put into those columns. So I assure you, your potential grantees pay a lot of attention to how they do those allocations, because they want to come up with strong percentages, and they also want to make sure that they're doing it in a fair and reasonable manner. In terms of transactions with interested parties, this is very interesting because one of the attachments that's important to the 990 is Schedule L, and the other one is Schedule R. And the reason why these are important is because this is actually going to tell you the transactions that they're having with interested parties, which would typically be a director, trustee, key employee, highest paid compensated person. So if there's some sort of transaction that merited disclosure in Schedule L, well, that doesn't have to happen, and you'll see a lot of organizations don't even have Schedule L attached to their 990. So if this one does, you're probably going to want to look at what happened during the year that it required them to disclose it on Schedule L. It may be that the Director of Finance has a loan from the organization. And if they do, there are follow-up questions on Schedule L. Did the board approve this loan? Do you have a written contract for this loan? Did everyone know that this was going to happen before it happened? There are other things that would be in there. For example, if the executive director's wife works at the organization and receives more than $10,000, that's required to be disclosed. If that happens, that's not necessarily a bad thing, but that might be something that a reader would be interested to know. That family members, spouses, whatever it might be, also work there and may be in a position where they're touching internal controls. And is there a concern about segregation of duties if husband and wife are controlling two parts of internal controls? So again, Schedule L is something to pay attention to. Schedule R is also related party transactions, but it's on the entity level, right? So this is going to tell you what other entities exist that this particular organization is related to. So maybe they have some sort of 501c4 that they're related to, a PAC, a political organization that they're related to. Maybe there is a disregarded entity that they control. Typically, they may have an activity that they want to shelter into a disregarded entity. Maybe it's a real estate transaction that they wanted to contain there, but you'll find out more information about that by looking at Schedule R. Schedule R asks you to detail what types of transactions happened during the year with that particular organization. So you'll check a box, do we share employees? Do we share states? Did we send them money? Did they send us money? And again, you can find that out. In terms of transactions in foreign countries, the IRS and the Department of Treasury pays a lot of attention these days to money that leaves the United States. So you'll see again in Schedule F of the tax return, this is yet another attachment. This will tell you whether this entity is perhaps running a foreign program or is making grants overseas, or a lot of times what you're going to see these days is that this particular entity has an investment outside the United States. And if that investment is over a certain dollar amount, it would get disclosed in Schedule F. So again, maybe nothing to be concerned about, but if you are a grantor that wants your money to stay domestically, then you want to just see what they're putting on Schedule F. In terms of special events, there is Schedule G as in gala, or gaming, however you want to say it. And that will tell you the three biggest events that they held, and it will give you details about whether or not they ran a raffle, whether they're using a professional fundraiser, mailing list, etc. So again, that schedule is very good in terms of your ratio analysis because it'll show you how much they're spending on these particular events versus how much income they're bringing in. I always use the example of golf outings. Golf outings are very expensive to hold and may or may not, depending on the economy, net a big bang for the buck. So sometimes you have to wonder, are they holding that golf outing really to raise money, or are they holding that golf outing because they really enjoy going to that golf outing? Okay. In terms of comparative data for certain years, the best thing about the redesigned Form 990 was that they brought all the key information to page 1. So on page 1, you really get a flavor and snapshot of the organization. It tells you right on the cover the mission of the organization, the total revenue and total expenses last year and this year. And then it tells you the balance sheet basically last year and this year in terms of total assets and total liabilities. So it gives you a very quick snapshot of how they did from year to year so that you can do a quick analysis. In terms of the endowment, in Schedule D as in dog, you will see pretty much the exact same endowment information that you should see in the notes to the financial statement. However, I will say when I look at financial statements, the one thing that I think a lot of financial statements are deficient in are the required disclosures about endowment. Although they've been required for quite some time now, I believe since 2008, for whatever reason, a lot of times the disclosures within an entity's financial statements are not complete. Well, there's no escaping it in tax return because otherwise your return get rejected. So if you're not finding the information about an endowment that you want to see, go to Schedule D as in dog, and you will actually see a year-by-year comparison of the endowment, and it will be everything. It'll be the permanently restricted. It'll be the income that the endowment earned. It'll be the spending of the endowment. So it should give you a nice comparison in terms of what they've been doing in terms of their endowment. Finally, the composition of the board. There's been a lot of questions in terms of independence of board members because on the cover of the 990, the IRS says how many board members do you have, how many of them are independent. And so there's a lot of confusion as to what does independent mean. And the way the IRS defines it is really has to be a financial interest. So your independence is impaired if somehow cash has changed hands. So if I'm on the board and I'm providing legal services pro bono, that does not impair my independence because you haven't paid me for that service. If I'm on the board of a school and my child goes to that school, I haven't impaired my independence because the school hasn't paid me anything. I'm paying them a service fee for my child to go to that school, and presumably I'm not getting any sort of discount or anything like that, which goes into a whole other thing. But in any case, usually what would impair your independence is that the organization is somehow compensating you for a service that you're providing, and again, it has to be over a certain dollar amount, and it somehow has to really benefit you personally. So if I work at an insurance company and the organization decides that they want to go with my insurance company because we give the best rates, just because I'm an employee there doesn't necessarily mean it impairs my independence. If by virtue of them signing up with the insurance company, I get a commission, or, for example, I actually own that insurance company, so it really does benefit me personally, that would probably impair my independence. So there's rules about that. But the question is, so what if 2 or 3 board members have their independence impaired? That probably is not a big deal, and you're probably going to see on the face of the 990 that 2 or 3 people may not be independent. The problem becomes when the majority of board members say that they have a problem, when they have a conflict of interest, because then who's voting on all the decisions? If all these people need to recuse themselves every time this organization needs to take a vote, do they have strong governance? Are they able to make decisions? Do they have arm's length transactions when they're going into these vendor relationships? Okay. So a lot of times what you'll notice is the information in a financial statement doesn't seem to match the information in the tax return. And so we always say, well, that's generally accepted accounting principles versus tax. And so for the tax year 2011, the first thing I always tell people to do is pull out Schedule D as in dog. Schedule D in the 990 is supposed to be your roadmap to explain to you how the audited financial statements are supposed to match the tax return. It will literally say the revenue from the audited financial statement is this number. We made the following reconciling items, and here's how we got to the revenue in the tax return on page 9. So that's why that schedule is so important. And although Schedule D is an attachment, it's basically a required attachment. You should never really see a 990 where you won't see a Schedule D, because Schedule D is a catch-all. It's not just this reconciliation. It includes the endowment information. It includes information about fixed assets. It includes information about things that you would call other liabilities or other investments. So Schedule D should almost always be there. And this reconciliation will really help you to understand why the numbers may look different from one to the other. One thing that you won't see in the tax return is donated services. And the reason being is because although certainly getting free legal service is a wonderful benefit, it's neither a good nor cash in hand to the organization. And so really within the financial statements is going to be true dollars that came in or goods that came in that they convert into cash as opposed to a donated service. So that's definitely one reconciling item that you would see. Another thing that you won't see on the revenue page of the 990 is unrealized gains or losses. What are unrealized gains and losses? They're really the change in market value of investments from year to year, but they're just that. They're not actual cash in hand. They're just letting you know that last year their portfolio was worth this and now it's worth this and this is the change. To the organization, unless they sell the portfolio, it's really kind of just a meaningless number, and therefore to put it on the revenue section would be somewhat misleading because it wasn't cash that ever hit their bank, right? Then you would see gross versus net reporting. A lot of times when you look in audited financial statements, you'll see pledges receivable, comma net, right? Or you'll see special events, comma net. What are we netting against these things? Typically with pledges receivable, you're netting a present value calculation, or you're netting some sort of allowance in case the pledges don't come in. A lot of times with investment income, you'll see investment income, comma net. What are we netting there? We're netting usually the transaction fees or the management fees that the entity is being charged every time they make a sale. In a tax return, those things get broken out very clearly so that you'll see the gross number, the reconciling items, and then you'll get back to the net number. So you should be able to identify the investment expenses that an organization has paid because they have to be pulled out for the tax return. Whereas in the financial statements, it may be harder to come up with that number because they're allowed to present it net. Okay. Then you'll take a look at, again, I mentioned special events. The special events in terms of the 990 will be in an attachment. So again, you'd be looking for Schedule G to see the detail of the special events. Within the financial statements, you'd probably see one line on their statement of activities that says special events, and it'll probably say net. And what is it net of? It's net of what we call the direct benefit to donor. Direct benefit to donor is by attending your event, what did I personally get to enjoy? Because part of the money I gave you went to pay for that, and so that portion is not charitable. So for example, you invite me to a dinner benefit. I've bought a seat at a table. I've paid $100 for my seat, but you've given me a free meal. Well, not free, but you've given me a meal, you've given me my seat, and perhaps I get to listen to a band, right? So I have paid for my meal and my seat to be there and the entertainment, and the amount above that I have paid is considered the charitable portion. So the organization has to come up with their matrix to determine what direct benefit to donor is, but it should be things that the attendee got to directly enjoy. What it would not include would be the postage on the invitation. I didn't get to enjoy your postage, right? Or let's say the development person that you hired, their salary doesn't directly benefit me. So those things, although they are related to the special event and you would see them in Schedule G, would not be netted directly against the income in the financial statements because they're not directly related to the person that went to the event. So you see here that the expenses related to the event in the financial statements, you're not going to see them perfectly with the revenue. In the tax return, you're going to see every expense they spent on that event versus the income that came in on that event. So you're going to see more of a 1-to-1 ratio in the tax return. In the financial statements, it might be a little muddied. We had a question? Mm-hmm. Mm-hmm. So the question is, when the entity is calculating the direct benefit to donor expense, and they have things that have come into them pro bono in kind, for example, maybe the band performed for free, is that, should that be part of their direct benefit to donor calculation? The answer is no. It really should be based on the cash that the entity laid out for these particular services. I want to caution you, though, because something that gets very confusing is we all know when we get those invitations, on the invitation down below it actually says $50 is the tax-deductible portion of this particular thing. And people always ask me, what's that based on? That's usually printed and created before the entity has even really paid the expenses yet or know what's going to be the ultimate expense. So it's really an estimate. You're never going to actually be able to calculate $50 times 1,000 people versus what they say is the direct benefit to donor, because it's not a perfect match. It's an estimate of what we think is the value of what you're getting when you went to our event. Okay, so we're going to start to talk about red flags and things that you should be concerned about as you start to go through both the financial statements and the tax returns. But one of the things that I wanted to discuss was a reminder about the Clarity Project, because this is something new that you'll start to see in December 31st, 2012 audited financial statements and going forward. So in our world, this is very exciting because things don't change that quickly usually. But basically, the Clarity standards are really things that affected auditors, nothing too much for you all to worry about. The one thing that it did affect was the opinion page of the audited financial statements. The opinion page will look different for December 31, 2012 and going forward. So what the Clarity Project did is it basically said, how many of you have looked at the opinion page of an audited financial statement and could not find where we actually give our opinion? Right? I mean, I myself sometimes scroll 3 times before I actually find the sentence that says that we believe these are free from material misstatement. So what the Clarity Standard said is, why should people have to work that hard to find your opinion? Let's break it out. So now there are subheadings for the reader so that you know exactly what each paragraph is trying to tell you, and there's an opinion subheading, so it should be very clear as to where we're finally giving our opinion. The other thing that the Clarity Standard did, which is very interesting, is it forced accounting firms to reference both the functional expenses and the notes to the financial statements in their opinion. We never had to reference those before. We only had to reference the balance sheet, the statement of activities, and the cash flows, and the changes in net assets. Now, by causing us to include that when we give our opinion paragraph, the idea here is, of course, reiterating the fact that those are integral parts to these financial statements, and the auditor should feel comfortable opining over the financial statements in totality. Okay. Another thing that you want to take a look at when you're looking at the opinion page, first you want to see what type of opinion it is. So when we say that we found these financial statements to be free of material misstatement, and you don't see anything else, there's no except for or anything like that, that's what we call an unqualified opinion. I always think that is a little bit of a misnomer because unqualified sounds like we didn't do our job very well, but actually unqualified is the best you can do. That's a good opinion, right? If you see a qualified opinion, that's usually when you see an except for. So basically everything was good except we had an issue with one particular thing and we're going to tell you about it. So, you know, you can kind of take that with a grain of salt. We're not walking away here. We're not saying that this entity is, you know, materially misstated, but in this particular area, we feel like maybe they didn't follow GAAP, or maybe we had an issue valuing an investment, and that investment is integral to these financial statements. It's a material amount. So sometimes you'll see an except for paragraph, not a terrible thing, but something to keep in mind when you're doing your analysis. Then you have a disclaimer. Disclaimer is basically saying something happened that impeded our ability to do all of our procedures, okay? And that could be various things. That could be that we simply couldn't get enough information on opening balances to make ourselves comfortable. And so we're letting you know that while what we looked at during the year we were very comfortable with, the opening balances in these financial statements, we had trouble actually proving those out. Maybe they switched accounting firms and for whatever reason the transfer of information wasn't there. And so as the new accounting firm, we're letting you know that we're not necessarily comfortable with opening balances. Or it could be something more serious, like the client wouldn't allow us to perform one of our audit procedures. For example, we like to confirm things like inventory or confirm things like pledges receivable because there's such a material number. If the client said, I refuse to allow you to confirm those things, we might have to put a disclaimer on the financial statements because we weren't allowed to do all of the procedures that would give us comfort on whether or not these were free from material misstatement. The worst opinion that you could have would be an adverse opinion. And an adverse opinion is basically saying, we think that these financials are either materially misstated or they're simply not in accordance with GAAP, and we could not get comfortable, right? So an adverse opinion would be something that you really would be concerned about and probably wouldn't want to necessarily give money to this organization, or definitely would merit a phone call and find out what happened, right? In terms of what you're looking at, you always want to see whether or not the opinion and the cover of the financial statement say anything about consolidated. You want to know whether you're looking at your potential grantee, or maybe you're looking at a larger entity and your potential grantee is consolidated within these financial statements. If you are an entity that is controlled by a parent, you're not required to have standalone financial statements. So that's another reason why the tax return may become even more important, because the tax return may be the only place where you get to see how that smaller entity is actually doing as compared to looking at what the parent is doing. You see this a lot with hospitals. Hospitals have centers within them that may have their own tax ID number, and perhaps as a grantor you want to give to the center. You're not necessarily trying to give the hospital at large because you're giving for a very particular purpose. If you look at the audited financial statements, the center is such a minute part of that big machine of hospital that you're probably not going to be able to find out much. But instead, if you go to the audited, if you go to the 990, you can really see how that center is doing. Another place where you see this a lot is with universities. A lot of universities have centers within them, and if you want to give to a particular center, again, go to the 990, you should see how that center is doing. Okay. Also, when you see those words, supporting organization or wholly controlled, those let you know that this entity answers to a higher power, if you will. Perhaps the higher power is the one that elects their board. So they do have their own board, but it's completely elected by the parent organization, and so the parent organization can kind of cherry pick who they want to sit in that room and make decisions. Perhaps there's an overlapping majority between two entities, which is basically an element of control, if you will. Or a lot of times if we are a supporting organization of another organization, then we're basically saying we're in the business to support the mission of this parent, and ultimately probably we turn over a majority of our revenue to the parent. So we may collect our own donations, but ultimately those donations flow into the pool up to the parent. Okay. Another thing that you want to take a look at is the basis on which the financial statements were prepared. In order to get an unqualified opinion, they have to be prepared on a GAAP basis, generally accepted accounting principles. If they are not prepared on a GAAP basis, they're not going to get an unqualified opinion. Reasons why they might not want to is they may not have a requirement to turn in financial statements to anyone other than maybe the board. So for example, if an organization is on a cash basis, which most of the time that's what the board looks at throughout the year because they make their decisions on what cash is actually sitting in the bank, then if they don't have to give audited financial statements to New York State or to a bank because they have a loan, or to a government agency because they get a grant, well then there's no real reason why they need to be on a GAAP basis. So maybe just for ease of use, they decide to stay on a cash basis. Actually, you'll see some private foundations are on a modified cash basis. And that is because there are certain tax accruals that come along with being a private foundation. The private foundations kind of feel like, well, is this really necessary? You have to set up any sort of tax accrual so that a reader would know if you closed your doors tomorrow, how much tax you would potentially owe. So it's kind of not a real tangible number because the organization's not going to close their doors tomorrow. So that might be another reason why they say, well, we'd rather just be on a modified cash basis because that accrual is such a huge number and it's fictional. It's not a real tangible expense that we're going to incur. Okay. So here is what the new format looks like. So at the top, you see that we're giving you the report on the financials. We're basically telling you what they contain. And here's where you see that we wrote related notes to the financial statements. This particular organization doesn't have a doesn't have a functional expense. So that's why you don't see it mentioned. If it did, then you would see that mentioned in the first paragraph. Then we talk about what management's responsibility is in terms of these financials. Again, this page is the only page that the auditor owns. These financial statements are really the organization's, their management's financial statements. We're just trying to attest that we believe that they're fairly stated. So this is the only page that we own. Right below that, you see the auditor's responsibility, and we talk about the procedures that we did. One of the things that's very important is that we'll talk about the fact that we're looking at things, but we're looking at things on a spot check basis as opposed to checking every single number and every single thing that happened during the year. So that's why we always say we believe they're free from material misstatement. Could somebody have stolen a pencil? Possibly. Are we always going to catch that? Probably not. And so, you know, when you're looking at this, you kind of have to take it with a grain of salt that we can never give you 100% assurance because we're not testing every single thing that happened during the year. Okay. Also, in terms of internal controls, a lot of times people get confused what the auditor's role is in terms of testing internal controls. As you know, on the commercial side, there are the internal control audits and reports that come out. They're called stock reports now. Those reports actually go through the internal control structure and they render opinion on the controls themselves. In terms of the audited financial statements of an entity, the auditor's not rendering an opinion on the control structure itself. What they're telling you is that they gained an understanding of the controls in order to design, plan, and perform our audit procedures, but we're not rendering an opinion on the control structure itself. We're rendering an opinion on the audited financial statement balances that are in these financials. So remember that if you are someone that is very concerned about the controls of the entity, you may want to ask them, have they ever chosen to undergo an internal control audit? It's an outside audit. It's an extra expense. Sometimes a board will recommend that the organization do this maybe once every 5 years just to see how they're doing. Could they be doing things better? Certainly in the nonprofit world, there's a cost benefit to everything. There are ways to enhance your controls without having the most gigantic finance department in the world. But maybe the entity is unaware of some of the things they could be doing that wouldn't necessarily be a huge expense, but would strengthen the controls. Okay. Finally, our opinion. There it is at the bottom. And basically, we're telling you that the financial statements present fairly in all material respects the financial position. So this is an unqualified report. In terms of the financial position, here is why I always say there's so much variance in terms of sample financial statements. Financial statements may give you a classified balance sheet, they may not. Classified balance sheet means that we will actually give you subheadings of these are our current assets, these are our non-current assets, these are our current liabilities, these are our non-current liabilities. Where you will see that very often is an entity that actually has debt because banks like that information. So they may actually format their financial statements the way the bank wants them to present it, and that way they can hand it over and the bank's happy and their loan stays in good faith and everything's great. Since it's not a requirement, you probably won't see that. Instead, what you should see, though, is that the assets should still be presented in order of liquidity, right? So that's why you should always see cash on top. And probably the last thing you see at the bottom in terms of the assets would be property, plant, and equipment, because that's the most illiquid thing that they would have. The same thing in terms of the liabilities. The short-term current liabilities, accounts payable, those things that they'll probably be paying next month will be on top. And then their longer-term debt will be below. So that's why there's going to be always some flexibility. On the statement of financial position will always be the condensed classification of net assets. So again, here you would see the three categories of unrestricted net assets, temporarily restricted net assets, permanently restricted net assets. The changes and what happened all year long in terms of those categories is not on the balance sheet or statement of financial position, it's on the statement of activities. So when you flip the page, you'll see how they arrived at those numbers. But on the balance sheet, it's a snapshot of here's where they ended at the end of the year. And so now you have a sense of how much is unrestricted versus how much they actually have to do something to make a donor happy before they can use that money. Or perhaps a period of time needs to expire before they can touch that money. Okay. Doing a current ratio, again, you want to take a look at the liquid assets and hopefully they exceed the current liabilities. You can do a debt ratio if the organization has debt. A lot of times they don't, so you may or may not be doing that. So here's a typical balance sheet that you would see or statement of financial position. And so again, we begin hopefully in order of liquidity. So we've got cash and cash equivalents on top, the investments and the pledges, and there's where you see that word net. Hopefully every time you see that word net, there's a note disclosure in the back that tells you what it's net of. That's the way it should work. If it doesn't work that way, that's another great opportunity to go to the 990, and you should see the gross amount of pledges, net of, and it will tell you the amount of allowance. Okay. Again, we take a look at liabilities. Right on top is going to be the accounts payable and accrued expenses, and then we move down towards those things that are the longer-term liabilities. This organization has debt, so they have a bond payable at the end of the year. You see the place where we wrote commitments and contingencies, note M. This is very important, and again, this is going to vary firm to firm. Our firm feels like this is important enough that we want to stick it on the balance sheet. We're letting you know that this organization has commitments outstanding that are not necessarily booked as liabilities, but we think that you should be aware of them. So what we're doing in big, bold letters is basically saying, go to the notes, go to the notes. And you will find a commitment and contingency note, and we told you what it is, note M, that's going to tell you what's out there that maybe didn't get booked because it's not required to be recorded, but you should know about it, right? Then the net asset categories. So people always get very confused in terms of what is board designated. Does everyone in the room know what I mean when I say that term? No? Okay, let's talk about that. So board designated endowment is basically that the board took a vote and said, let's set aside $3 million and treat it like it was given to us from the outside as an endowment. So that means let's lock away $3 million, right? And we will use the income off of that to serve a particular purpose, right? And so why would an organization want to do that? Perhaps the organization had an unbelievably great year. Somebody made a huge gift to them. The gift was unrestricted. So now they're sitting with all this unrestricted cash. Well, this board is concerned about long-term planning, right? They want to make sure that this school stays in business forever. So they've had a good year. They think it is conservative and good long-term planning to lock away some of that money and create this predictable stream of income so that the school can now operate off the earnings of that, and they have that at all times, right? So that may be a reason why they would do it. The reason why you don't see that number in the permanently restricted category, even though they've locked away the $3 million, is because it was a board action. It was the entity that chose to do this, which means that next year, a newly elected board could say, nah, we don't think that's a good idea. Let's take that money out, right? So at any given point, that money can either be locked up, not locked up, and it can flow because it's all at the decision of the entity itself. It's not an outside donor. So what you see on the permanently restricted line are the amounts that came in from an outside donor, where the outside donor said, I'm giving you $3 million. You may not touch it. I want you to lock it away. And you can use the income off of that to pay teachers' salaries, let's say, right? Because it's an outside donor, and just so you know, New York State is an incredibly donor protective state. So donor letters will really trump everything else. The donor can say, I want you to do this, and you have to do it unless, for whatever reason, you feel that you can't, in which case you have to go back to them and ask for variance. You have to ask their permission before you go ahead and use their money for some other purpose that they didn't tell you you could, right? So on the permanently restricted line, It's permanently restricted because donors told us it has to be that way, and there's no real flexibility in terms of moving that unless we got some sort of variance. Another variance that may happen that you may have heard about recently in terms of the new endowment law would be what we call side-pray. So a perfect example is Yale, right? Yale University has been in business for how long? And they had endowments going back so long ago that you couldn't believe, and it was for buckets of water for the horses to be kept outside of the classroom. And so, you know, millions of dollars sitting in an account that they can't use because that simply doesn't work anymore. And as you can imagine, whoever gave them that money is no longer living, right? So Yale, not wanting to, you know, break the rules, keeps that money and permanently restricted, and every year it just sits there and it collects income, and that income can't be used, and it just keeps building and building and building. Then they get some negative press article, let's say, that says Yale has this gigantic endowment and it doesn't spend the money on education, which they would love to spend the money on education, but because they have to honor the donor, they can't. So what they do is they then go to the courts and they do something called side-pray, where they basically say, we want to stand in the shoes of the donor who's no longer alive, and we want to ask the courts to give us relief because we have all this money and we can't use it. And so what we'd like to do is use it for another charitable purpose, and will the court grant us permission to do that? That's how serious this is. That's how much effort it takes to actually undo these endowments. You need a judge giving you permission, or you need a donor to put it in writing, right? So permanently restricted is, in my mind, locked away, right? So when I'm looking at this organization, I think they look pretty healthy. They have 7 million of unrestricted. Sometimes you're going to be looking at one of your potential grantees, and you may see a negative balance in your unrestricted line, right? What does that mean? If you think about it, what that really means is that means they have to be borrowing from the donors, right? Because if they're running at a deficit, but they're keeping the lights on, how are they paying their bills? They have to be borrowing against the temporarily restricted money or the permanently restricted money. So that's of concern. If you see a negative balance in unrestricted, that's something that you should really follow up, and that should be a red flag to you that something's wrong here, right? One of the things that might happen for an organization, so it's important to think about this, is they send out letters that say every single dollar you give will be used for research, right, which is phenomenal. But then people respond to that letter, and that literally means that every single dollar that comes in has to be used for research. So how do they pay their electric bill? How do they pay their rent? How do they pay their salaries? So sometimes the organization accidentally gets itself into trouble because they use too strong of language in their actual solicitation, or they don't have board members or other donors giving them unrestricted gifts. So it may be that they fall into that position accidentally, but that's one of the reasons why you'd want to follow up, and maybe they can explain what happened and how they're going to fix it. Okay, so here what I've done is I've kind of grouped for you the current assets and the current liabilities and done the ratio. Again, the idea here is, would you be able to have enough resources to pay all your debts over the course of a year? And again, here, as you can see, they have a very strong financial position. Their assets exceed their liabilities by a lot, by 10 to 1, basically. So this is a very strong organization. A lot of times, because an entity doesn't even have debt per se, what you're really looking at is, I see these amounts sitting in accounts payable and accrued expenses. Do they have enough cash to cover their bills? So you might want to think about it that way. Also, you know, depending on how much information you want to ask for, if you see that number, accounts payable and accrued liabilities, very large, you may want to follow up the grantee and just say, you know, can I see an aging report of accounts payable? Or are you having trouble paying your bills? Because maybe that's the case. Maybe they're literally letting things go past 90 days because they just don't have the cash and resources to pay bills. So again, debt ratio, total debt divided by total assets, and that gives you the percentage of an organization's assets that are leveraged. One of the things that's important to know about are debt covenants. A lot of times the bank will say to an organization, you have to have $2 million worth of unrestricted net assets. or you must maintain this debt covenant account where you basically lock away $2 million so that we feel comfortable that you'll always be able to make your payments, right? And so it's always important to know what the debt covenants are and whether the organization is meeting them every year. Given the recent financial times, I believe a lot of banks have been flexible in terms of granting variances if, for example, the organization had a rough year. But again, if they break the covenant, technically the bank has the right to pull the loan. So you always just want to read the notes in terms of what type of debt they have. Maybe they have the IDA bonds, in which case, you know, that technically they've got public bonds out there, and so the covenants on those are usually significant. Or maybe they have a private bank loan, which is giving them a little bit more flexibility. Maybe they just have a line of credit, and you'll see in the financing section of the cash flow the changes in debt, right? So I always go to the financing section of the cash flow to see this particular year, how much did I draw down on the debt, how much did I repay of the debt, where did I end up during the year? Okay. Yep. Right. So the idea here is that when you're looking at the debt ratio, you're trying to take a look at what percentage the debt is of the organization's total assets. So here, 16%, I would say that's relatively a healthy percentage, right? You know, what we've done here is we've said they've got $3.7 million out of $22 million. And imagine on this type of debt, their repayments every year, let's say, are probably $250,000. Clearly, they have enough money to continue to make their payment. So I would be more concerned when the percentage starts getting more towards 40%. That might make me concerned. 50% would certainly make me concerned. But you just want to take a look and really understand in the notes of the financial statements, they will tell you what the upcoming minimum amount of payments are. So it should say this organization is required to pay $250 a year, right? When I'm taking a look at the total assets, I'm taking a look at whether or not this entity is going to have the ability to keep making those $250 a year payments. Okay. So again, I would say as it starts to get up to more 40, 50, 60%, I would get concerned. But the other thing that I would take a look at is this is a little misleading because I've told you that they've got $22 million, and we've taken that just against their debt, right? But this is where I want to go to that other commitment note and see what else they have to pay. Maybe they have to fund a very large capital call on an investment, right? And so they're going to have to pump $2 million into an investment next year. Well, now when I take a look at the total assets, and I know that $2 million is going towards an investment, do they still have enough money to pay their debt? So just doing this ratio is probably not enough. You want to do this ratio, and you also want to read the commitment and contingency note and see what's not booked, and make sure that when you look at both of those things that they could fund their debt. Okay. In terms of the statement of activities, they're going to identify for you the major revenue streams. They may show you possible concentration of revenue streams. Again, you may or may not see that. You may see the functional expense totals. So let me just kind of go back and talk about what you may see when you're looking at statement of activities. An organization can present these in various ways. You may see some organizations that up above will say revenues from operating activities, revenues from non-operating activities. So what they're telling you there is we run a health education program, and here is all the money that came in for people that attended our classes, et cetera. Down in the non-operating revenue stream may be realized gains, dividends, and interest, because yes, that's revenue that's coming into us because we have investments, but that's not part of our program, right? So they may present it that way. They don't have to do that, right? So there's a lot of flexibility in terms of how they may show you their different categories of revenue, okay? Same thing with expenses. You probably will see expenses from operations, and again, that's going to be telling you what they're really spending their money on in terms of their programs. And then non-operating expenses. Non-operating expense, a perfect one, is the post-retirement pension liability. The reason why I point that out is because that's always a very significant number, especially these days with the economy. And that's one of those GAAP fictional numbers. Just like we talked about the tax accrual that probably will never happen, this is something that's kind of unfair to the nonprofit, because what it basically says is you have a defined benefit plan where you've basically said that you promise to provide benefits to all these people when they retire, and you have to fund that plan. So you only have to fund a certain amount every single year, and an actuary tells you how much you have to put in, and that's fine. And that organization is probably doing that. But then GAAP came out and said, you should actually pick up the liability for the entire funding of the plan based on an actuarial calculation. So what that means is, if everyone retired tomorrow, how much money would I have to pump into the plan, because right now it doesn't have enough assets to cover everyone that retires, right? So we all know that not everyone's going to retire tomorrow, right? And so it's kind of unfair to the nonprofit that they have to pick up this extra liability. And so every year that amount changes because the discount changes, or the expense of healthcare changes, or their plan assets, took a nosedive because the market tanked. So every year they're picking up additional expenses, and they're never going to pay that expense. Not in any given year will they pay that expense. So that's something that they will almost always say is a non-operating expense, or they'll put that below the line, because they're trying to tell the reader that this is not an actual outlay of cash. This is GAAP forcing us to book this accrual, right? So that's why I just want to point out to look for the things that you see kind of below the line or in the non-operating section. Here's where you can start to take a look at the service ratios. So in the statement of activities, you may see total program expenses, total G&A expenses, total fundraising expenses. They don't have to show it there. Perhaps what they're going to show you instead is total expenses from program and total supporting expenses, and they don't break that into management and general and fundraising because they don't have to. If you don't see it in the statement of activities, you should see it someplace else in the notes. If you don't, for whatever reason, that's when you're going to go to the 990, because you will definitely see it in the 990. Okay. I've given you a couple of ratios here. Again, and there are various watchdog agencies that have certain feelings about the percentages and what they should be. Obviously, a program service ratio of 86% is very good. And fundraising ratio of 5% I think is normal and average. There's a fear for these organizations to put anything in fundraising because they seem to get such negative press for it. There are organizations out there that will put 0 in fundraising, and I always think that's interesting because I know they have a development director. I know they send out solicitations where they held a special event. So I don't think it's a bad thing to have a number in fundraising, and 5% I think is very reasonable. And then G&A. G&A can be somewhat of a misnomer because there may be things that happen during the year that are going to hit G&A. Depreciation expense, bad debt expense, things that the organization may get hit in a particular year that make that percentage high, and that's not necessarily a bad thing. So really, I think what you want to focus on when you're looking at these particular ratios is what is the ratio in program? Is it, I would say, you're looking for something hopefully above 60%. Again, if it's below 60%, you just want to talk to them, find out the reason. And then you want to take a look at fundraising. You just don't want to see fundraising 25%, 40%, whatever it might be, because then you start to say, all right, how much is this organization really spending on their own programs as opposed to just trying to collect donations, right? So I pay very little attention necessarily to the G&A because I feel like that's kind of the catch-all plug. I pay more attention to the program probably first, and then I take a look at the fundraising. Yeah, it is. Well, it's in this particular organization, it is very low. One of the things that I just want to mention is on the statement of activity, on the functional expenses in the 990, the IRS has now come out, and this is not for the 2011 forms, so these are not the forms that you're going to see yet. But the 2012 forms, the IRS has finally come out and said You don't have to put bad debt expense on here. You can go ahead and put bad debt expense in the other changes to net assets because we know it's not real outlay of cash. And basically what it's saying is we had this wonderful donor who pledged $1 million and then turned his back on us, right? And so we had to write that off. Is it fair to punish the organization twice by not only did they lose this contribution, but now they're going to get killed in their ratings because they have this huge number as bad debt expense sitting in G&A, right? So the IRS said, okay, go ahead and put that in other reconciling items. They've also said, put that actuarial change that we just talked about for the post-retirement, you can put that into your other changes to net assets. With those two things removed, you probably are going to start to see the G&A number get smaller. You're used to it being a lot larger because of depreciation, because of bad debt, because of that actuarial calculation. So I do think this is a low number, but I do think in 2012 tax returns and going forward, you may see G&A start to get smaller because they've been given permission to move those things out, and those are big ticket items. Right, so what we basically did here is we basically said, what is the bang for your buck, right? So for every dollar that came in, how much did you actually spend to raise it? And so here, again, 8 cents on the dollar, it's not horrible. You know, could they be doing things to bring in donations without spending a lot of money? It depends. You know, do they have an expensive special event? Do they have development staff? Do they hire a professional fundraiser? So again, you just want to see, what you don't want to see is 50 cents on the dollar. So they're basically, you know, giving away half of every dollar that comes in to pay for fundraising. So here's your statement of activities. And here you're going to see the 3 categories. So I always want to take a look at what happened in the unrestricted column. Again, to me, that's free and clear of any sort of restriction. So that's the money that the organization can spend at will. And so hopefully I see some contributions coming in that category because I know that they can use it for whatever they need. And I also want to take a look at who's giving them money, right? So in this particular organization, they're getting 2.5 of government grants, right? Government grants typically don't get renewed for, I would say, if a grant got renewed for more than 3 years, that would be unusual, right? So maybe they'll apply for a different type of grant, but if they're relying on one particular significant grant, I have to know in my mind when I'm analyzing them that that's going to end at some point, right? So I just need to take a look and say, okay, this year, in terms of contributions, they got $10 million. But at some point, that $2.5 million may go away. Do they have enough outside support from other donors to keep going in terms of their contributions? And here they look relatively healthy. They've got over $4 million coming in, having nothing to do with their government grant. So they seem to be doing okay. Below that is money coming in from other sorts of things. For example, here we sell catalogs. So we've got catalog sales. Change in value of split interest agreements. Again, this is almost like an unrealized calculation. Somebody's given me some sort of split interest where I'm not allowed to touch it until that person passes away. So really I track the value of it year to year, and hopefully it goes up every year. But at the end of the day, that money doesn't really come into my pocket until that person passes away. And then, again, we have other income. And then we have support and revenue before net assets released from restrictions. So here is the line where it's telling you this is all the money that came in for the year. This is pretty much the amounts that came in. Then below that, net assets released from restrictions. What this is saying is we had money given to us for various purposes or restrictions, and we were able to satisfy those restrictions. So that line, the reason why it nets to 0 is that's not new cash. That's movement from column to column, right? And so hopefully what you're seeing is you want that to be a healthy number because you don't want the organization to constantly take in restricted monies and not be able to use it, right? So if you never see them releasing any of the money, that might be concern because you'll start to get into that situation where we end up with negative unrestricted net assets. We've got all this temporarily restricted money and we simply can't use it. Below there, this particular organization not only gave you their total program amount at M&G and fundraising, but they broke out for you their 3 major programs. Again, they don't have to do that, but that's certainly nice. And then the only thing that's required in a nonprofit's financial statement are 3 things, basically. You have to give the total unrestricted, the total temp restricted, the total perm restricted. Somewhere you're supposed to give the total program expenses, the total M&G, and the total fundraising. The other thing that you have to disclose is the change in net assets. That's why it's bolded, right? You have to tell somebody what the net income was for the year, right? So here, at the end of the day, with all the movements, what we're basically telling you is we netted a surplus of $1.1 million, right? So, okay, not bad, especially when I take a look at last year, which is the column right next to it. Last year, I only netted $600,000. So I did better this year, right? At the end of the day, here are the totals for my column. That's $7.3 million. That's my total unrestricted net assets. That matches the balance sheet number that we saw before, right? The 2.4 is temporarily restricted. That means that somebody gave me money for a particular purpose, or maybe it's time restricted. I should, at some point in the future, be able to satisfy that purpose, and I'll get to utilize those funds. And then the permanently restricted. That's 6.7 has been designated by an outside donor, and they've told me that I have to lock that away. So that is sitting in either a cash account or an investment account, and I'm not touching that $6.7 million. Very important, if you think about it, doesn't have to be dollar for dollar, right? But if someone has said that I've got 6.7 of a permanently restricted endowment, and then I looked at my balance sheet and I only have $1 million on my balance sheet in terms of assets, where's that money then, right? I mean, wouldn't that imply that I've spent the money if I only have $1 million worth of assets? So you might want to compare the permanently restricted money to my total assets and just make sure that somewhere that money is sitting locked away like the donor told me to, okay? It may be very rare, but it may be in your permanently restricted number is some sort of fixed asset, a building, piece of land, where they basically say, we've given this to you and you can never sell it, right? So they've put some sort of permanent restriction on it. So it doesn't have to be that I have $6 million in cash. It doesn't have to necessarily be I have $6 million in investment, but total assets should exceed the $6 million, okay? So again, program service ratio, we took the total program expenses over the total expenses, and we came up with 86.3. I always like to compare this to last year. And the reason being is that they're not supposed to change their methodology from year to year. They're supposed to stay consistent so that in one particular year they're not trying to look good for a reason. You know, maybe they were going to do a major campaign or whatever. So I always like to see what the percentage was last year. And if I see a big swing, then I want to take a look at how they allocated the expenses, probably in the tax return. I'm going to hold last year's tax return against the current year tax return and see if there was a particular line that got manipulated or that got allocated differently, and just find out why, right? And again, fundraising ratio, I think 5% is fine, 6% is fine, and again, that seems to be in line. And then cost of fundraising, again, we talked the fundraising expense divided by total contributions, and we basically said 8 cents on the dollar. Last year it was 9 cents on the dollar, and that seems reasonable as well. Statement of functional expenses, if you have it, that's great. Again, most organizations are not required to give you that information. Only a health and welfare organization is required to do it. But it's very helpful in terms of doing your variance analysis. What you will find is that a lot of nonprofits are giving you the statement of functional expenses anyway because the information's in the 990. So it's no secret, and since it's already out there in a public document, why not have your audited financial statements give that information? So you probably see it more often than you won't, but if you don't, that's not a cause of concern because it's not required. And here we go. Again, these are the typical categories you'll see, but they can make these categories anything they want. The categories don't have to match the categories in the tax return. So again, we can give more detail, less detail. In the tax return, they actually break out legal fees on one line, accounting fees on another line, investment management fees on another line. Perhaps in the financial statements, we've just aggregated all professional fees onto one line item, and that's fine. Again, I like to take a look at what my depreciation expense is out of my total expenses because I know that's not an actual outlay of cash. So when I look at my total expenses, I like to subtract out the depreciation expense and then see where I am. Again, if there's bad debt expense, I would subtract that out as well. But then I want to take a look at things such as salaries. Do I think that they're reasonable? Employee benefits and payroll taxes, again, are those reasonable? Here we do have a professional fundraiser. That's fine. And that will be disclosed in the tax return on its own line item. And then I want to take a look at occupancy. Again, nonprofits tend to run pretty lean. You know, operating in New York is an expensive thing, but are they in $1 million, you know, office space? And maybe that's somewhat of an unnecessary expense, and that a lot of that money could be going towards their programs. So again, just getting a sense of what they're really spending their money on and whether or not that's an important utilization of their money. Statement of cash flows, again, it's broken down into operating, investing, and financing. And here you can really see the sources and uses of cash. So the first section is always going to be your net cash provided by operating activities. This format that you are looking at is called an indirect cash flow. There are two different types of methods that you can use approved by FASB, in accordance with GAAP. You can either use the direct method or the indirect method. The majority of times you're going to see this, which is the indirect method because it's easier and it's shorter. But the FASB really doesn't like that. The FASB would prefer that people use the direct method. What the direct method does is before it gets to that change in net assets, it literally shows you cash from contributions, expenses related to contributions, cash from special events, expenses related. It will literally break down where the cash came from and then show you the expenses related to that to bring you back down to your change in net assets. So the direct method has all this information plus more. The reason why that's somewhat of a pain is that makes complete sense in the commercial world, right? You want to see how much cash came in from customers, how much cash came in from, you know, financing, from investors, whatever it might be. That makes sense. In the nonprofit world, you pretty much know where your cash is coming from. It's either going to be from your members, if you're a membership organization, or from your donors. To make nonprofits do all that work is cumbersome. The reason why I'm telling you this is because probably in the next 3 to 4 years, you're going to hear that everyone's being required to move to the direct method. That's been in the pipeline, and it's kind of been stalled given everything else that's gone on in the economy. But at some point, they do want to force everyone to start using the direct method. And in the year that that happens, that's going to be probably a delay in financial statements coming out, because for nonprofits, getting that information in the right categories is going to take a little bit more time. So I just want to point that out. Here, what I like to see is net cash provided by operating activities. Typically, I mean, this is what they're in the business to do, so hopefully they're generating cash from that. So I feel comfortable when I see that cash is coming out of their operating activities. Net cash used in investing activities, I'm not surprised or concerned when I see that as a negative balance. That's them taking the money that they've earned and reinvesting it. So they're investing in themselves. So that's hopefully a long-term planning strategy. And the reason why I say long-term planning is that's not just investments that's in that line. That's also purchases of property, plant, and equipment. So this is literally them investing in their own infrastructure, right? So that being negative is no concern. Net cash flows from financing activities. Here's where I see the repayments of bonds. So again, if that number ended up being a negative number, that probably would be a good thing to me because it shows me that they've made payments. If I saw a gigantic positive number that would say proceeds from bonds, I would know that they issued more debt or they drew down on their line of credit this year and probably didn't make payments yet to repay it. The other thing that's included in here is something that actually nets out one-to-one. So you see the 774 contributions restricted for permanent endowment. That number is netted against the negative number up above. What we're basically saying here is I started with my change net assets, and I'm going to subtract the perm number that came in because I really don't have access to that cash. So when I'm giving you the amount of cash provided by operating activities, I think it would be misleading to tell you that that includes 774 when I'm not going to be allowed to use that for my operating activities. I have to lock that away, right? So instead, you'll see that positive number in the financing activities. It's not really a financing activity, it's an outside donation, but this is the area where you see money for again, long-term projects. So what this is basically saying is somebody has given us a gift and it will be part of our endowment, right? So that nets out. At the end of the day, I see a decrease in cash of $240,000. Again, not concerned. I have plenty of cash to begin with. You know, $2 million worth of cash maybe is something that's not the best idea, right? What's that cash is doing sitting in the account? Could we be spending that on programs? Could we be investing it and earning a return as opposed to letting it just sit in the account? So allowing that cash to go down $240,000 is probably a good thing. Below that are just some supplementary information that you're required to disclose. Interest paid for the year, that would be interest paid on our bonds. So that has to do with our debt. And then we're just letting you know how much came in for donated services because that's not actual cash in our pocket. And donated supplies, so somebody gave us a good as opposed to cash, another place that we disclose it. Footnote disclosures, very important. The first note that you always see is the policy organization note. It just tells you what is the mission of this organization. What are they in the business to do? And it's important that you know that because you want to compare that to their statement of activities, right? If I'm in the business to solve the AIDS crisis and give money to AIDS victims, and then I look at my statement of activities and I see things about the environment or that kind of thing, while that's still charitable in nature, there's always a danger because you don't want to stray from the mission under which you received your tax exemption, right? And if you do stray from your mission, you want to make sure that you've gotten permission first before you do that. So how do you do that? You expand your bylaws to include other things besides just the AIDS crisis. And then you basically file your 990 with a note that says, by the way, we've updated our bylaws and we've expanded our mission to do the following, right? That way, you've done it legally and you put the IRS on notice. Still doing something charitable, maybe not related to AIDS, but nothing wrong there. The other thing that you would see in that note is the year of incorporation and the state of incorporation. Why is that important? You want to know what state they're organized in because that's where somebody could bring a lawsuit, right? That matters because every state has their own rules. There are certain things that are illegal in New York that may not be illegal in Delaware. And so, for example, in New York, an executive director is not supposed to have a loan from the organization. Other members of management can, but the executive director is not supposed to. If they're incorporated in the state of Delaware and the executive director has a loan, is that illegal, right? So the question is, where would a lawsuit be brought against them? And so that's why you just kind of want to know what state they're operating in. The rules may be a little bit different. Another thing where this applies is the endowment law. The endowment law that the organization follows should match the state that they're incorporated in. You've heard probably the term MIFA. I hate the term, but basically that is New York's version of the Prudent Management of Institutional Funds Act, right? And so New York has caveats in their endowment law that other states don't. New York has this 8-factor test of your investment that the board every year is supposed to discuss these 8 factors and make sure that the general management over the investment portfolio is prudent and reasonable. Other states don't have that in their law, right? New York had to, when it enacted the law, had this donor notification requirement where the organization had to send letters to everyone that had given them a permanently restricted gift to the extent that they had that information available and ask their permission, do you want to be under the new law or the old law? Other states didn't have that. So if I see that my organization is incorporated in the state of Delaware, I know that their rules over their endowment might be a little bit different than what I'm used to because I've heard about New York's law. What should not be different is the endowment disclosure, right? The law that the organization is subject to is different than GAAP. GAAP has preliminary disclosures that say you have to tell us the 5 following things about your endowment. We don't care what state you're in. You have to tell us these 5 things. That's why I always get concerned because I see that the endowment notes are lacking a lot of times in financial statements. And that shouldn't be because the disclosure requirement is the same no matter what state you're in, right? Then we talked about a summary of accounting policies. This will tell you probably how they depreciate their fixed assets. It may tell you if they accrue for vacation, and information about major account balances. Usually in a nonprofit financial statement, I'll see a note about pledges. I'll see a note about the detail of fixed assets. I will absolutely see a note about the details of temporarily restricted. So if I've got $2 million in temporarily restricted, I hopefully have a note in the financial statements that tells me of that $2 million, $100,000 is restricted for salaries, $20,000 is restricted for flowers, $1,000, and it will give me the breakdown so I can understand what makes up that balance and maybe why the organization can't utilize it all in 1 year. One of the things I point out is there's a note, it used to be called FIN 48. It's now ASC Topic 740. Again, these are things that we recite and they mean nothing to anyone. So ignore my jargon, but the point of this is it's regarding income taxes. Now, why would a nonprofit have to have a disclosure about income taxes? You have to have a disclosure about the tax position that you've taken. A nonprofit has taken the tax position that they're not subject to taxes, right? In this disclosure, you would let the reader know if there's been anything that's happened during the year that would change the tax position that you've taken, right? So what would that be? Perhaps there is an open IRS investigation. That would be a good note to let the reader know. Perhaps this organization has failed their public support test so many times that they are no longer going to be a public charity. They're going to become by default a private foundation, and now they're going to have to start to pay excise taxes. So again, typically this note is pro forma. It just says, look, our tax position is that we're a nonprofit and we're not subject to taxes. We don't have any tax accruals because we don't have any taxes. And by the way, the past 3 years that are open for inspection by the IRS, we haven't been contacted about any sort of investigation. The reason why I point this out is that a nonprofit is not required to attach their audited financial statements to the 990. They may be required to attach it to their New York State filing or to another state filing, but the audited financial statements are not required to be attached to the 990. And in fact, maybe a nonprofit doesn't even have an audit, right? But in the 990, the IRS cares about this note so much that actually in Schedule D, they ask you to verbatim copy this note into your tax return, right? Because they want to see what you're saying about your tax position, right? They want to see if you're being truthful and honest with those reading your financial statements about whether or not they've got an open investigation or whether or not you have any sort of tax accrual that you should be making. So it's rare, actually, that the IRS asks you for actual information letter for letter from your financial statements, but this is one place where they have. Okay. Again, in the footnotes, you may see a note regarding concentrations. Here's where we may say, by the way, 25% of our revenue actually comes in from government grants, and those government grants are not going to get renewed next year. We're not concerned for the following reasons. Or maybe 60% of our donations have always come from one particular donor, but we're working on it, and we think that the mix next year will be different or whatever it might be. But you want to look for that note because that may be of concern. And again, subsequent events, commitments, and related parties. The date on the opinion is important to look at because that's when the auditors received the last part of evidence that allowed them to issue the financial statement. Usually that last part of evidence is really the ref letter. And the ref letter is management representing to the accounting firm that they take ownership, basically, of their organization and the numbers and whatnot. So that's not really the last piece of evidence. The last piece of evidence is is whatever is outstanding before the auditor feels comfortable issuing the report. That could be a confirmation. That could be some sort of investment literature that we need, or whatever it might be. If the date on the report, if you're let's say a 12/31/2011 year end, and your financials didn't get issued until November of 2012, I wonder why. I wonder what held up the report that it took that long for the financial statements to get issued, right? Was it a disagreement between the accountants and management and it took that long to resolve? Was it something that happened during the year, for example, maybe some sort of litigation that everyone felt that we should really just wait and see the outcome before we go ahead and release the financials in case we need a note disclosure? Or was it something like a piece of investment evidence that the investment management company simply doesn't issue that statement for this length of time? But if I see a huge gap in date, that's always a question that I probably want to ask them, which is, why does it take so long for you guys to get your audited financial statements? The reason why I bring that up is, in terms of the financial statements, subsequent events, management is required to disclose whatever's happened up through the date of the opinion, right? So our opinion is dated, let's say, April 3rd. So even though they're a December year end, if there's a material subsequent event, up until April 3rd, that should get included in our financial statements. That means if they entered into any multi-year, multi-million-dollar contract subsequent to year end, but it happened before we release our report, we're going to want to talk about it. If a lawsuit was filed that's of concern, and where the lawyers are telling us that we have a contingency that probably should get booked, again, that's going to be in these financial statements if it happened before our date. If it happened after the date, then it's not going to be in the set of financials. Okay, so here's again where we just talked about the organization note, and down below I just gave you a sample note. Again, we were formed in the state of New York in 1983, and we're here to help people with serious illnesses, and we left that very vague. So that gives us flexibility, of course, to work with different types of illnesses. And again, below that I told you that these financial statements are prepared on an accrual basis. You would expect to see that because there's an unqualified opinion on the first page, which means that these have to be accrual because that's what GAAP says. I just wanted to go through some of the notes that I thought were more important. Here, the investment note, you may or may not get cost in this note. They're not required to give you the actual cost of the investments. They're required to give you the fair value of the investments. I love it when they give costs. And the reason why I love that is because I can see that last year my cost was 68.8. This year it's 70, right? So I pumped about 1.2 million into these investments. But look what happened. My fair value didn't go up. It actually went down, right? So I invested more money and I lost more money. So that's why I love it when I have cost and fair value, because maybe normally if I just had fair value, I would see that last year the fair value was 84, this year it's 81, and I would say, oh, well, I probably sold some investments. Well, I didn't in this case, but I wouldn't know that because I didn't see the cost. Also, this lets me know what types of things they're investing in, and it tells me that this particular organization seems to be pretty well diversified. Part of that New York State endowment law is that you have to basically explain the rationale of your investment decisions, right? So if you're not going to diversify, if you're going to stick everything into domestic limited partnerships, you probably in your minutes have to explain why you thought that was a good idea. Because domestic limited partnerships are illiquid as compared to, a share of Disney stock, right? So again, this will let me know in the different categories how each of these investments fared, and it shows me that they're well diversified. The other thing that goes on is this leveling, right? And so this can kind of get confusing because what do all these levels mean, right? So to kind of break it down to bare bones, you should never get too concerned that an entity has things in level 3. That's not a bad thing. Level 3 gets a bad rap, but it's really not a bad thing. What we're basically saying here is level 1 means that the auditor can independently value this investment and get an identical value for what you own, right? So what that means is forget confirming with an investment manager. You own a share of Disney. I can go on Google Finance and I can look up that share and I know exactly what it's worth based on the date you purchased it and based on the date of these financial statements. And I could own that same share and get that same valuation, right? So I don't have to rely on anything. I can independently value it and come up with an identical value. So that's level one. Level two would be debt, right? So you own debt and you bought it on a certain date. I can buy that same type of debt, but I'm probably buying it 2-3 weeks later. It will be worth almost the same thing, but it won't be identical because we didn't buy it on the same date, right? So in level two is what we call a model valuation, right? So I may not be able to get the identical value of what you did, but I can do procedures to come up with a model where I feel comfortable enough over the valuation where I'm almost there, right? Level three is where the auditor can't independently value the investment. So level three basically means that you're invested in some private equity investment and either the investment manager refuses to give us the underlying detail of the asset, or they do, but those are not things that I can look up on Google Finance. Those are things like they may own real estate, they may own things in other countries, and so even if I have the detail of your assets, I can't independently value them or I can't come up with a model valuation. So really, in terms of the fair value in these financial statements, how did I get there? And the investment manager sent me a confirm and said, this investment is worth this. And we took that verbatim. There's not much else that we can do to prove that value. So what this note is doing is it's telling you how much work we were able to do to prove the values in these financials. And the reason why that's so important is because these numbers tend to be the biggest numbers on the balance sheet. So you probably want to know how comfortable we were with some of these numbers. So the fact that you have some level three investments, that seems to kind of be the state these days where because of diverse portfolios, there's always going to be some portion of the portfolio that's private, that the investment manager is not going to give us what we need to independently value it, or they're investing in things that we simply can't look up on the internet or get confirmation independently. I would not be concerned. The only time I would be concerned is if 100% of the investments were all level three, right? Because then I would say, okay, the auditor couldn't get comfortable with any of those numbers. They completely relied on an investment manager. Was that investment manager lied, right? I mean, we know what happened with Madoff. So we know this is not necessarily always a foolproof plan. And then take it a step further. If I couldn't get comfortable with any of the investments because they're all level three, are those a material number to my balance sheet? Am I now not necessarily comfortable with the balance sheet because 80% of the balance sheet I couldn't independently value? In which case, maybe I have a qualified opinion. You know, everything seems to be in compliance with GAAP, but I just want to let you know that 80% of the balance sheet are in these investments that we couldn't get comfortable with, right? So nothing is concerned here other than if you were to see, let's say, 100% of the assets in level three. If you have anything in level three, the auditor, or not the auditor, management is required to give a roll forward of level three. So you would start with whatever was in level three last year, and we would show you what happened to it during the year. Unrealized losses, a present value adjustment, maybe we had a sale, maybe we had a realized gain. That's not necessarily a big deal. It's just part of the required disclosure. More important, actually, is what comes underneath there, right? Part of the investment note these days is a note about liquidity in terms of redemption, how much notice you have to give, and unfunded commitments, right? If I'm in these alternative investments, these private equity investments where in order to go in there you have to promise at least $1 million, $2 million, whatever it might be, here's where I might disclose to you that, by the way, I have an unfunded commitment of $2 million. So over the course of I don't know how many years, I'm going to have to pump more money into this, which means that money's not going to be going towards my program, right? So I want to know this so that I can know where their cash is going to be going to. I also want to see how hard it is for them to get out of these investments, because if all my assets are in these investments and I can only get out of it once a year and I have to give 95 days notice, maybe I'm going to have trouble paying my bills, right? So that's another thing that I want to take a look at this note for. Here, this is the note about the pledges. Again, we're just letting you know when they're due to come in. Because we have some long-term pledges, there's been a present value calculation, which basically says we're not going to get this money in for another 5 years. So because of that, we present valued it to say what it's really worth today. And then they've set up an allowance of $550,000. There's no magic to the allowance. That's really a management decision. It's a management estimate that the auditor then reviews to see if it's reasonable. So for some organizations, the allowance may be a particular pledge that they're concerned about. So they may fully reserve that dollar for dollar. For other organizations, the organization may choose to take a percentage of all pledges and call that their allowance. So there's no magic to how they do it, but as long as the auditor believes that that's a reasonable estimate. Again, here's where we say they have a concentration provided by one donor, 18%. Again, 18% is not a huge thing, not necessarily of concern, but if every single year this person is a significant donor, are they going to start to impact our ability to keep passing our public support test, right? Related party note, again here, just letting you know that the organization entered into a significant contract, and it turns out that the organization has a key employee in common with this entity. So there, I'm just basically going to say, okay, that's fine. Conflict of interest. Did they do reasonable governance to make sure that this was still a good deal for them? Do I have to worry that there's any sort of private inurement or self-dealing here where somebody's going to benefit from this contract and maybe it was not a fair value contract? And then we've talked about subsequent events, and we've talked about donating materials and services. Real quick, the 990, we've talked about the core form now, about the detail of expenses, and we've talked about the detail of revenue. In the core form is a lot of checklists. What those checklists do is they set you up for whether or not there are additional filings or whether or not there should be additional attachments. So if they check yes to the fact that they had a special event, then you'll see Schedule G, right? If they check yes to the fact that they sent more than $10,000 or whatever it might be to a foreign organization, you'll see Schedule F as in Frank. So here's where you do that. Also within the core form are the governance questions. With those governance questions, for some of them, they are required to give explanations in Schedule O. We call that Schedule O for other, Schedule O for oh my God. If that's their chance, Schedule O is literally a blank slate where they can tell you anything they want about the organization. So Schedule O, just like the notes of the financial statements, very important to read to get a flavor as to what's going on here. If you see something unusual in the tax return, it may be explained in Schedule O. And then just a reminder that 990s, a lot of 990s these days are electronically filed. Not required to be, but most organizations at this point are kind of getting on board with that, in which case the tax return itself may no longer be signed. So where you see the box for signature within the core form 990, it may be blank. And the reason why is there's another form, it's called the 8453, and that's where the officer is signing. And so you may not see that 8453 on GuideStar, but just know that the IRS has a copy of it and that an officer did sign before this got released. This is what the 8453 looks like. And again, declaration of the officer, and they sign. And the tax preparer also signs on this form. So this is basically the permission to electronically file. This is page 1. This, again, I told you, is a snapshot about the organization. It gives you the flavor of the organization, tells you your mission, number of voting board members, number of independent voting board members, how many people were employed, how many volunteers they had. If they had unrelated business revenue, so this is basically when organizations decide that they have excess capacity and they want to make some money on the side, so maybe they're going to engage in an activity that would really be considered commercial, right? And if they do that, as long as it's a very small percentage of their total revenue and it's not taking up a lot of their program activity, they can do it. They just have to pay tax on it, right? So a perfect example is a lot of organizations say, you know what, we have all this space and we have these wonderful meeting rooms, and maybe we're going to rent them out and make a business out of that, right? So we're going to rent them out. We're going to provide security. We're going to provide catering. and that's going to be the little side business for us. You'll see a lot of membership organizations do that because they have all these rooms that are going unused at night, let's say. So as long as they do that and it's not a predominant revenue stream for them, they're allowed, but now they have to pay taxes on whatever they net from that activity. So on page 1 now, you're actually going to see, well, how much unrelated business revenue did you actually come up with? And this lets you know that this particular charity is running a little bit of a side business. Another time that they would have UBIT, or unrelated business income, would be from an investment. Anytime you have a debt-financed investment, that becomes UBIT. So basically, you're invested in something that borrowed money just to try to make a profit, automatically that becomes unrelated business income. And so they may literally, as a passive activity, I'm invested in a limited partnership. That limited partnership was leveraged with debt. Because I'm an investor, now have to pay some form of UBIT. So it may be that passive, but again, something to look at and be, cautious about. Here, typically you're going to see a Schedule A. Schedule A is the public support test. Schedule B is that list of contributors. What goes up on GuideStar is the redacted version of that list. So on GuideStar, you're not going to necessarily see the names of the contributors. It's going to be blanked out. You'll just see the amounts contributed. The actual names of the donors only have to be submitted to the IRS. It does not have to be made available to the public. Schedule D, typically you're going to see Schedule D no matter what. And it covers, as I mentioned, many things. The endowment, it covers that reconciliation. It talks about your fixed assets. It would talk about any donor-advised funds if the organization is running donor-advised funds. So Schedule D as in dog is a real catch-all. And here's where we start to ask questions about the governing body and management and whether or not any officer or director or employee had a business relationship with anyone else. If so, you might see Schedule L. Those are those interested party transactions. So depending on how they answer these questions, then you might go and see additional schedules. Here's where I mentioned we're going to disclose the policies. Policies such as conflict of interest policies, policies about compensation setting, whistleblower provisions, document retention. Again, the idea here is they want to be able to check yes because, that's governance practices and also they get rated on that. But they can only check yes if that policy was in place based on the tax year I'm reporting on. If they put that policy in place subsequent to this tax year, then they're going to have to check no. But in Schedule O, they may say to you, look, we didn't have a whistleblower policy, but it was approved by the board subsequent to year end. So feel comfortable that we do have one in place. We just didn't have it in place at the end of this particular year. That's why you always want to go to Schedule O and see how they're describing their policies. Here is that statement of revenue. At top is going to be their contributions, and it's going to tell you who they came in from, whether it came in from a fundraising event, whether it came in from a related organization, is it a government grant. Line G is a subset of all the monies above. So that non-cash could be mixed into any of those other lines. And then I'm just letting you know of the amounts I presented above, how much of that was a non-cash donation. Typical non-cash donation, somebody donates securities, right? We see that a lot. Somebody wants to basically wire shares of stock to us, and then we're going to sell it and make money off of it. So that's going to be included above. I'm just letting you know that some of that was non-cash. Below that is going to be income coming in from their program services. You see where it says business code. Business code was issued in terms of the original draft of the revised 990, but not required to be used. So you actually may see that column be blank. Doesn't mean that the tax return was filed wrong. You're only required to use the business code currently if you have a UBIT activity. Where would I see a UBIT activity? See where it says column C? If I have a number in column C, that means that I got income from some sort of activity that didn't have to do with my mission, right? So that would be that side business, or maybe that would be those investments I talked about. If I have something in column C, then I should have a business code that matches it. And the codes are based on a glossary that the IRS gives you, and there is a code for everything. There's a code for investing activities. There's a code for agriculture activities. So that code can also help you. If you go to the 990 instructions, it gives you the website. If you see a particular code, you can go on that website and you can say, okay, I see this code is for agricultural activities. What are they doing as a side business in terms of farming, you know? And it'll give you a little clue. But other than that, just so you know, currently you do not have to use the codes. Okay. Statement of functional expenses is probably where you spend most of your time. Again, this gives you all the detail. I condense it because it's too big to actually show on the sheet. This gives you all the activity of the expenses, similar to what you saw in the functional expenses, but even more detail. And I just point out that, again, they've broken out certain things, so you don't just put professional fees all in one line. You would say how much is legal, how much is accounting, how much would be lobbying, and you would break it out. And so they've tried to come up with a category for everything. The idea is that the IRS really doesn't want you to stick your expenses on other. They really want you to use the categories as they've laid them out. And so what they've done is, in the category of other, they've basically said that you can only have a certain percentage in this category. Other than that, it has to be up above. Well, I believe, I want to say the percentage was 10%. Whatever it was too high. I mean, 10% of total expenses is still a large number. So still a lot of organizations were burying expenses in other. The IRS in 2012 took it a step further. It said, fine, you guys want to keep using other? Everything that you bury in other that, you know, there aren't enough lines in other to show you what it is, you now have to go to Schedule O and break out all the components in Schedule O. So we're going to force you to show what's in your expenses, whether you want to put it on page 10 or in Schedule O. So you might as well use the categories as they're listed, right? But again, that's not for the year that you guys are going to be looking at currently. That's for 2012. That's a change that they made going forward. So it'll probably take over a year from now for you to start seeing that form make it to GuideStar. Okay. So some of the supplementary schedules that I think you should pay attention to. Public support, again, in order to be a public charity, that is a privilege. It's not a right. So every year you have to prove that you've earned the privilege. You do that by passing the test. The test is that you have to have over 33.33% of your donations from the outside public, right? So you want to look at Schedule A. On Schedule A, you'll see the percentages that they disclose. You want to see that they made over 33 1/3, and it will also show you last year's percentage. They are allowed to flunk, just so you know. They are allowed to flunk in a given year as long as they can attach facts and circumstances to explain why they flunked. So maybe this donor came in and gave them $20 million. Well, you know, they're never going to get enough donations from the outside public to match that. So they may flunk in a given year. They would attach facts and circumstances to explain why they flunked. The one time they'd probably really get in trouble with the IRS and they may lose their public charity status is if they go below 10%. Very hard. Once you've gone below 10%, it's very hard to crawl back up. So that's, if I see them a little below 33, not necessarily concerned, but I want to read what the facts and circumstances are. If I see them below 10, I start to get concerned that they're going to lose their public charity status. Okay. Schedule B, again, is the list of donors. Since you guys don't get to see the names, that doesn't necessarily tell you much. Schedule D, I told you, is going to help you reconcile, so you want to pull out Schedule D. Compensation, Schedule J. Schedule J is not the only place you're going to see compensation. You're going to see compensation on page 10, right? So you're going to see the total amount of salaries paid. Also in Part 7 of the core form is going to be the listing of all the officers and directors, the key employees, and the highest paid, the 5 highest paid. So you're going to see compensation in a couple of places. Schedule J is really just those that were paid over $150,000 worth of reportable compensation. So Schedule J is really just going to be those couple of people that got paid over that threshold. It's not going to give you a detailed list. The reason why Schedule J is great, though, is if they did pay somebody over $150,000 and they're required to fill it out, it asks all sorts of great questions about their compensation packages. Do you allow first-class travel? Do you give housing? Do you allow memberships to organizations? What's your expense reimbursement policies? How do you set compensation? So if they're required to fill it out, it's great because now they're also required to answer all these additional questions. But if you don't see Schedule J, it's probably because no one was paid over that threshold. So don't be concerned if it's not there. Schedule L and Schedule R, again, Schedule L, you know, I'd say 60% of the time it's not going to be there. So if it is there, I'm very interested in it because I want to know what happened during the year that was an interested person transaction and what are the details of that transaction and should I be concerned about that transaction. Schedule R is just telling me that we're related to another organization and maybe I'm interested in to find out what relationships we have and how we're related to that organization and whether or not we're sharing space or employees or if they give us money or if we give them money. So Schedule R, I probably know that information already when I read the financial statements, but interesting. Schedule L, I'd pay more attention to. Schedule L could be where a red flag would be. Okay. Schedule F and Schedule I. Schedule F are my foreign activities. Maybe I care about that, maybe I don't, but if I do, just know that on Schedule F, you're required to aggregate the activity by zone, right? So I'm not going to see every single grant I made to a foreign entity. I'm going to see the entire amount that I sent to the Caribbean zone, right? Or I'm going to see the entire amount I sent to Eastern Europe. So that's going to be all condensed, and you know, then I'm not going to know necessarily what's in that number. I don't know how much I gave for each program or each country. So the details in terms of Schedule F are not always as listed out. In Schedule I, which is where you give away scholarships and grants, you have to give the name of every single recipient, the full address, the EIN number, the purpose of the amount, as long as it's over $5,000. So any grant you give away under $5,000 wouldn't get listed. But any amount over $5,000, you have to give the full details of it. To Schedule I, if you're an organization that gives away grants, Schedule I can be 300 pages long. And that's fine, so, but just know that Schedule F is never going to give you the same level of detail. Okay. Again, Schedule O, very important. Schedule O, just like the notes of the financial statements, is where I'm going to see all those other things that I might not have known about because maybe they're not financial in nature, but they're concerning my governance. Or they're concerning something that happened this year that I would want to know about. And here I just gave you a quick snapshot of what these schedules look like. Again, this is Schedule A, this is my public support test, and as you keep scrolling all the way down, you see that 92.64%. That's how much I passed by, and below it is my percentage last year, so I'm very healthy. I passed my test with flying colors, right? Here, in terms of Schedule B, if you go to GuideStar, you wouldn't even see donor A, donor B. It would just be blank on that line. So all you would see is $575,000. You have no idea who it came in from. So Schedule B doesn't really give you a lot of information. Schedule D, we talked a lot about this. Again, I mentioned it has multiple pages and it's kind of a catch-all. On the first page is conservation easements and donor advised funds, things the entity may not have. So the first page of Schedule D may be blank. But keep flipping because as you get to the other pages, you'll see the endowment. You'll see that FIN 48 note that we talked about, the uncertainty in income taxes. So you'll see the other things that you'd want to check out. Again, here's a snapshot from Schedule D of the endowment disclosure. As I mentioned, it's ultimately going to be a 5-year comparison. Every year a column gets grayed out. And here we also give the percentages, how much of this was permanently endowment, which means outside donor, how much was board designated, and how much is temporarily shifted. Temporarily shifted is usually the earnings off of the endowment. Again, just more parts of Schedule D that we've talked about. Again, we talked about Schedule D gives you the reconciliation from the tax return to the audited financial statements. And explains why they may not match. And this is what it looks like. And again, they break down donated services, unrealized gains. They actually break down the things that could be causing them not to match. If I put something on the other line, just so you know, I have to then tell you what other is someplace else. So don't get concerned if it's all on the other line because then that just means there's an attachment that tells you what other is. Schedule J, again, they may or may not have to complete this, only if somebody got over 150,000 of reportable comp. But if they do, this is how they break down the salaries. Then they'll tell you that how much went into a retirement plan for this person, and how much they received in non-taxable benefits, which would be if the organization pays health care on their behalf. And then below there, they're going to talk about how they set compensation. Schedule L, again, if it's there, I definitely want to read this. This could be a place where I might find red flags. Business transactions with an interested person. I want to find out what this is all about here. I've got a daughter of a trustee that works for us. I've got somebody that's providing legal services that got compensated $100,000. And then column E says, well, did they get to share those revenues? And I've said no. So that makes me feel a little bit better because I know that they're not privately getting a benefit out of the fact that we use this law firm, right? Below that, identification of related tax-exempt organizations. Again, here I might disclose other entities that we're related to and just disclose them. Schedule O, this is where they are required, it's not optional, they are required to give you details about some of the governance policies. If they don't complete Schedule O, the tax return is considered incomplete and may be returned to them by the IRS. There's now a question in the core form checklist that says, did you complete Schedule O? So many people weren't completing it. The IRS actually added the question as their very polite reminder that this is not optional. You have to do this. And here they'll tell you about their various policies in terms of their conflicts of interest, again, and the compensation setting. What they did before they filed the 990, who reviewed it, etc. I froze. Am I the lesson? Okay. So this is the last slide. So again, Schedule O, great place to find out extra information about the organization. They can put anything they want in Schedule O, but the notes in Schedule O are supposed to be presented in the same order as the 990 itself. So hopefully it should match the order. It should make a little bit of sense. But again, because this is a free-form response area, it may not work out that way. But again, want to make sure you read that. This can be many pages long. There's no limit on how many characters you can use here. So that's really it. Thank you, everyone.